Listen, I want you to picture something. A Saturday morning in April of 2026. A kitchen table in a split-level house in Aurora, Colorado. Her name is Jennifer. She is 56 years old. She is a registered nurse. She has 2 kids, a mortgage with 8 years left, and a salary that covers the bills. Her mother, Eleanor, died 6 weeks ago at age 79. Eleanor had lived in the same house in suburban Denver since 1981. She bought it for $87,000. It is worth $640,000 today. Jennifer is sitting at the kitchen table with the estate attorney on a Saturday morning because Eleanor left the house to Jennifer and her brother Kevin in equal shares. The attorney is explaining the step-up in basis under Internal Revenue Code Section 1014. The attorney explains that Eleanor's house received a stepped-up cost basis equal to its fair market value on the date of Eleanor's death. The date of death appraisal established the value at $638,000. Jennifer and Kevin's basis in the inherited house is $638,000, not $87,000. The $551,000 of appreciation that accumulated during Eleanor's 45 years of ownership is permanently eliminated. If Jennifer and Kevin sell the house immediately, they owe 0 capital gains tax on any of that appreciation. 0. The attorney smiles. Jennifer nods. She understands this is a significant benefit. She calls Kevin from the parking lot after the meeting and tells him the basis news. Kevin says that's great. They agree to list the house in May. Jennifer is satisfied. She drives home. She does not know that 3 weeks ago, before Eleanor died, Eleanor had sold $180,000 of the Vanguard index fund portfolio she kept in a joint taxable brokerage account with Jennifer. Eleanor sold it because she needed to fund the final months of in-home care, and because she and Jennifer had discussed simplifying the estate before the end. The sale generated $127,000 in capital gains above Eleanor's cost basis. Eleanor paid $19,050 in federal capital gains tax and $5,334 in Colorado state capital gains tax on those gains. $24,384 in total capital gains tax paid on $127,000 of gains. Gains that the step-up in basis at Eleanor's death, which occurred 3 weeks after the sale, would have eliminated entirely if the positions had been held rather than sold. Jennifer does not know this yet. She will learn it when the CPA prepares Eleanor's final tax return in February of 2027 and explains the timing. Eleanor sold $180,000 of appreciated securities 3 weeks before her death. She paid $24,384 in capital gains tax on gains that the step-up at death would have forgiven completely. Eleanor made a rational financial decision in the moment. She needed cash for care. She did not know she was going to die 3 weeks later. The sequencing was wrong by 21 days, and it cost the estate $24,384 that the step-up was designed to preserve. That is the first layer of the step-up planning trap. The second layer is what Jennifer and Kevin almost did with the house before the estate attorney explained the step-up. 3 months before Eleanor died, when it became clear that full-time in-home care was needed and that the costs were significant, Eleanor's neighbor told Jennifer that she should put the house in Jennifer's name to protect it. The neighbor had done this with her own mother's house years earlier. Jennifer almost quit-claimed the house from Eleanor into her own name. She did not, because the elder law attorney she called for a consultation told her not to, citing Medicaid look-back rules she was not fully tracking at the time. The attorney's advice was correct for Medicaid reasons, but there is a second and equally important reason the quitclaim would have been catastrophic for Jennifer. If Eleanor had quitclaimed the house to Jennifer before her death, the house would not have been in Eleanor's estate at the date of death. It would have been a lifetime gift. Lifetime gifts do not receive the step-up in basis under Section 1014. They carry the donor's original cost basis to the recipient. Jennifer would have received a house with Eleanor's original basis of $87,000, rather than the stepped-up basis of $638,000. When Jennifer sells the house, she would have owed capital gains tax on $551,000 of appreciation at the combined federal and Colorado rate. At 15% federal plus 4.4% Colorado, the capital gains tax on $551,000 is approximately $106,470. Eleanor's well-intentioned attempt to protect the house would have cost Jennifer $106,470 in capital gains tax that the step-up at death eliminated for free. That is the second layer. The neighbor's advice, and the radio show advice, and the friend's advice, and the quit-claim deed strategy that circulates endlessly is advice that destroys the step-up and hands the IRS a capital gains bill that would never have existed if the asset had simply been held until death. That is what we are covering today. 4 specific actions that preserve the step-up benefit and 4 specific mistakes that destroy it. We are going to model each one in real dollars. We are going to show what each action and each mistake produces in capital gains tax for the heirs. And we are going to walk through the planning sequence that ensures the step-up works for every asset in the estate, rather than being accidentally destroyed. Smash the like button right now. The step-up in basis is the most valuable passive tax benefit available to American families building generational wealth. It is also the most consistently misunderstood provision in the estate planning context, because the actions that preserve it are counterintuitive, the actions that destroy it feel logical, and the financial media covers the estate tax and the capital gains tax as separate topics, without connecting the step-up preservation strategy to both simultaneously. Every like puts this analysis in front of one more family where the parent is still alive and the step-up planning window is still open. Hit it, subscribe, flip the bell. The suits in legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of Internal Revenue Code Section 1014 and the 4 planning actions that maximize the step-up benefit. Consult an estate attorney and a fee-only fiduciary who models step-up preservation in the context of your specific asset portfolio. What I can do is show you the math. Let me start with the foundational mechanics. Internal Revenue Code Section 1014A1 provides that the basis of property acquired from a decedent is the fair market value of that property on the date of the decedent's death. The step-up is automatic. It requires no election, no form, no action by the heir. At the moment of death, every asset in the decedent's estate that is included in the gross estate receives a new cost basis. The embedded capital gain that accumulated during the decedent's lifetime is permanently eliminated. The heirs inherit with a clean basis. They can sell immediately and owe 0 capital gains tax on any appreciation that accrued before the date of death. The provision applies uniformly to property included in the gross estate. It does not apply to property transferred by gift during the decedent's lifetime. Lifetime gifts carry the donor's original basis to the recipient under Internal Revenue Code Section 1015, the carryover basis rule. The step-up and the carryover basis are the 2 poles of the same planning axis. Assets that remain in the estate until death receive the step-up. Assets transferred by gift before death receive the carryover. The planning imperative is to ensure that the right assets are in the estate at death, and that the assets most likely to generate capital gains are not transferred as lifetime gifts to heirs who will be forced to carry the donor's original low basis. Now let me identify the 4 actions. Action 1. Hold appreciated assets in the taxable estate and distribute retirement funds for living expenses during the owner's lifetime. This is the most important sequencing decision in step-up planning, and the one most consistently executed in reverse. Eleanor had a Vanguard brokerage account and an IRA. She sold from the taxable Vanguard account to fund her care. The taxable account had embedded gains that the step-up would have eliminated. The IRA distributions are ordinary income, regardless of when they are taken. The IRA has no step-up benefit because IRA distributions are ordinary income to both the owner and the heirs. There is no capital gain inside an IRA. There is no basis step-up inside an IRA. The IRA's embedded gain is always ordinary income whenever it is distributed. The taxable account's embedded gain can be eliminated if positions are held until death. The correct sequencing for a retiree with both a taxable brokerage account and an IRA is to draw from the IRA first and preserve the taxable account for the step-up. Not because IRA distributions are cheaper than taxable account distributions in the current year, but because the taxable account's embedded gain disappears at death, while the IRA's ordinary income liability remains regardless. Eleanor drew from the taxable account because the immediate cash flow was clearer from the liquid index fund positions. She did not model the step-up cost of selling appreciated positions versus taking IRA distributions in the context of her estate plan. The sequencing error cost the estate $24,384 in capital gains tax on gains the step-up would have eliminated 3 weeks later. For a larger portfolio with $500,000 in embedded gains in the taxable account, the sequencing error in a single year of selling taxable positions rather than IRA distributions could cost $75,000 to $125,000 in avoidable capital gains tax. Action 2. Title jointly held real estate correctly for the state's property law to maximize the step-up at the first spouse's death. This is the community property versus non-community property state distinction that determines whether both halves receive the step-up. In the 9 community property states, California, Texas, Arizona, Nevada, New Mexico, Idaho, Louisiana, Washington, and Wisconsin, jointly held marital property that qualifies as community property receives a full step-up on both halves at the death of the first spouse. A $600,000 house purchased for $150,000 in a community property state receives a $600,000 basis for both spouses. Both halves. The surviving spouse can sell immediately and pay 0 capital gains tax on the $450,000 of appreciation. In the other 41 states, including Colorado where Jennifer and Eleanor live, jointly held property receives only a 50% step-up at the death of the first spouse. The deceased spouse's half steps up. The surviving spouse's half retains original basis. The surviving spouse sells with a basis of half the original cost plus half the date of death value, resulting in taxable gain. For a $600,000 house in a non-community property state purchased jointly for $150,000, the surviving spouse's basis after the first death is $75,000 plus $300,000, equaling $375,000. The taxable gain on the surviving spouse's $300,000 half if they sell is $300,000 minus $75,000, equaling $225,000. At 15% federal plus Colorado's 4.4%, the tax on that gain is approximately $43,875. In a community property state, the same spouse owes 0. Tell me in the comments right now. Tell me your approximate home value and your original purchase price. Tell me your state. Tell me whether you have appreciated assets in a taxable account you've been drawing from while the IRA compounds untouched. Tell me whether your estate attorney has modeled the step-up benefit in the context of your current strategy. Drop it in the comments. I read every single one. Now let me show you the 4 mistakes that destroy the step-up and the real dollar cost of each mistake. Mistake 1. The quitclaim deed transfer of appreciated real estate to heirs before death. This is the neighbor's advice mistake, the radio show advice mistake, the cocktail party mistake that circulates in retirement communities from coast to coast. Transfer the house to the kids now. Protect it from Medicaid. Get it out of your name. Every version of this advice has the same consequence. The quitclaim before death converts the step-up property into carryover basis property. The heir receives the original owner's basis. The embedded gain becomes the heir's capital gains liability. For Eleanor's house, a quitclaim at any point would have converted $638,000 value into $87,000 basis, and saddled Jennifer with $106,470 in capital gains tax on appreciation that the step-up at death eliminated for free. The only rational reason to consider a lifetime gift is Medicaid look-back planning, where 5-year protection may outweigh the step-up benefit. Even in that context, the trade-off must be explicitly modeled. The step-up foregone must be weighed against the Medicaid recovery prevented. The neighbor's advice does not do that calculation. It simply says transfer the house, without modeling the capital gains consequence for the heir. Mistake 2. Selling appreciated taxable account positions to fund retirement while the IRA sits untouched. Eleanor's specific mistake. The taxable account positions had embedded gains that the step-up would have eliminated. The IRA distributions carry no step-up benefit. Selling from the taxable account to preserve the IRA is the backwards sequencing that cost Eleanor's estate $24,384 in 3 weeks. The correct sequencing, all else equal, is to distribute from the IRA and preserve the taxable account for the step-up. Every dollar of IRA distribution funds the current need. Every dollar of taxable account position sold before death is a step-up benefit destroyed. The sequencing error compounds over time. A retiree drawing from the taxable for 10 years is destroying 10 years of step-up benefit, while preserving 10 years of ordinary income liability in the IRA. The correct sequencing produces lower lifetime capital gains tax, lower estate capital gains tax for the heirs, and the same ordinary income tax on IRA distributions, regardless of when taken. Mistake 3. Donating cash to charity rather than donating appreciated securities. This is the mistake of generosity without tax awareness. Eleanor donated $8,000 per year to her church from her savings account. She wrote checks. She took the charitable deduction. She received no benefit from the step-up on those dollars because cash has no embedded gain. If she had instead donated appreciated shares, the church receives $8,000 of fair market value and sells the shares tax-free. Eleanor receives the same $8,000 charitable deduction, and the $8,000 of securities donated is removed from Eleanor's estate without ever generating capital gains tax. Embedded gain is eliminated through charity mechanism rather than step-up mechanism. Both paths eliminate the embedded gain on those positions. Charitable path achieves elimination during lifetime on an asset chosen for donation. The step-up path achieves elimination at death on the remaining portfolio. The two mechanisms are complementary. Donate the most appreciated positions first, hold the remaining for the step-up at death. Combined strategy minimizes capital gains tax at every level. Mistake 4. Making a large deathbed gift of appreciated securities within a year of death. This is the timing mistake. Destruction of a step-up days away. A gift of appreciated securities made within 1 year of death may or may not receive special treatment depending on gross estate inclusion rules. For gifts made more than 3 years before death, the carryover basis applies, and the step-up is permanently destroyed. For gifts within a year, analysis depends. The practical lesson is that large gifts of appreciated assets in the final year or two of life carry significant risk of destroying the step-up. The neighbor's quitclaim deed advice applied in the final year of life is particularly dangerous because it destroys the step-up, potentially triggers 3 rules, the 3-year estate inclusion rule, and may also generate a Medicaid look-back penalty. All 3 consequences from one well-intentioned piece of advice. Now let me give you the geographic dimension. In Colorado, state income tax rate on capital gains is 4.4% as ordinary income. Full step-up eliminates $106,470. A quitclaim before death would have generated that tax for Jennifer. The step-up at death eliminates it entirely. In California, state income tax reaches 9.3%. The step-up on a $640,000 house in California eliminates approximately $149,000 in combined federal and California capital gains tax, among the highest in the country, because the state adds 9.3% to the federal rate on every dollar of eliminated gain. In Texas, there is no state income tax. Step-up eliminates only federal layer. The Texas step-up benefit on the same house eliminates only the federal capital gains tax of approximately $82,650 at the 15% rate on $551,000 of gain, smaller absolute terms. In Florida, same as Texas, eliminates only the federal layer. Florida Air and Texas Air both benefit, but to a lesser absolute degree than California or Colorado Air. Now let me give you the 5-step action sequence. Step 1. Inventory every asset you own with an embedded capital gain and calculate the gain in each. For the primary residence, the gain is current estimated value minus original purchase price. For taxable account, gain is current value minus total cost basis. For farmland or investment real estate, gain is current value minus adjusted basis after depreciation. For closely held business interest, current FMV minus tax basis. Step 2. Rank the assets by embedded gain. The asset with the largest embedded gain relative to value has the highest step-up preservation priority. That asset should be the last to be gifted or sold during lifetime and the first to be targeted for step-up preservation. Step 3. Review distribution sequencing. If you are currently drawing from the taxable account while the IRA compounds, reconsider. The IRA should be the primary distribution source. The taxable account with large embedded gains should be preserved for the step-up unless specific reasons, like Medicaid planning, override the argument. Step 4. Evaluate the titling of jointly held real estate in context of state community property rules. If in a non-community state, consult attorney about the community property trust option to maximize step-up at first spouse's death. If in a community state, confirm property is correctly titled. Confirm correctly titled as community property rather than joint tenancy, which may not receive the full community property step-up treatment in your state. Step 5. For any non-publicly traded assets in the estate, retain a qualified appraiser to establish a defensible date of death value within 60 days of death. The appraisal is the documentation that supports the stepped-up basis. Without it, the IRS can challenge basis claimed on future sale. Appraisal fee is worth paying. Save this video right now. Hit the save icon. Add it to the estate survival playlist. Because the step-up is automatic at death, it requires no planning to receive. The planning is required only to avoid mistakes that destroy it. Wrong sequencing, well-intentioned quitclaim, cash donation, or deathbed gift that looked like planning. Jennifer walked away with $638,000 of stepped-up basis on a house she can sell for zero tax. She doesn't know Eleanor paid $24,384 in tax 3 weeks before death. She will learn it in February 2027 from the CPA's final return. It will sit with her. Not because Eleanor made a terrible mistake, because Eleanor made a rational decision without the complete tax picture. The complete picture is the step-up preservation calculation applied to every distribution and transfer decision in final years. That calculation is what your estate attorney should be running and what your financial planner should be modeling alongside IRA strategy. Usually those happen in separate rooms. Subscribe if you have not, flip the bell, comment with your home value, original purchase price, and state. Tell me whether you have appreciated positions selling for retirement while IRA grows. We calculate the step-up preservation opportunity together. I read everything. The IRS gives heirs a tax gift at your death. The gift is the elimination of every dollar of capital gain that accumulated during lifetime on every asset in your estate. Gift is worth $106,470 on Eleanor's house. It is worth $24,384 on the Vanguard positions she sold 3 weeks before death. It is worth whatever the embedded gain is on every appreciated asset you hold today. You do not have to do anything to receive it. You only have to not destroy it before you die. Hold the appreciated assets. Distribute from the IRA. Donate the appreciated securities to charity instead of writing checks. Title the real estate correctly. Do not quitclaim the house. Let the step-up do the work. I will see you in the next one. Stay strategic. Stay furious. The step-up was written into the code in 1954. Your heirs entitled ever since. Make sure they receive it. Listen, I want you to picture something. A Saturday morning in April of 2026. A kitchen table in a split-level house in Aurora, Colorado. Her name is Jennifer. She is 56 years old. She is a registered nurse. She has 2 kids, a mortgage with 8 years left, and a salary that covers the bills. Her mother, Eleanor, died 6 weeks ago at age 79. Eleanor had lived in the same house in suburban Denver since 1981. She bought it for $87,000. It is worth $640,000 today. Jennifer is sitting at the kitchen table with the estate attorney on a Saturday morning because Eleanor left the house to Jennifer and her brother Kevin in equal shares. The attorney is explaining the step-up in basis under Internal Revenue Code Section 1014. The attorney explains that Eleanor's house received a stepped-up cost basis equal to its fair market value on the date of Eleanor's death. The date of death appraisal established the value at $638,000. Jennifer and Kevin's basis in the inherited house is $638,000, not $87,000. The $551,000 of appreciation that accumulated during Eleanor's 45 years of ownership is permanently eliminated. If Jennifer and Kevin sell the house immediately, they owe zero capital gains tax on any of that appreciation. Zero. The attorney smiles. Jennifer nods. She understands this is a significant benefit. She calls Kevin from the parking lot after the meeting and tells him the basis news. Kevin says that's great. They agree to list the house in May. Jennifer is satisfied. She drives home. She does not know that 3 weeks ago, before Eleanor died, Eleanor had sold $180,000 of the Vanguard index fund portfolio she kept in a joint taxable brokerage account with Jennifer. Eleanor sold it because she needed to fund the final months of in-home care, and because she and Jennifer had discussed simplifying the estate before the end. Make sure they actually receive it. Strategy is key. Stay strategic. Stay furious. 1954.